Hey everybody, good afternoon. It's Mike from orderflows.com, and I'm excited to have you here today. I'm just going to let some more people join in. We're getting started. Normally, I like to do these, um, around 10 a.m. Central Time. It's a little bit later. It's lunchtime, so hopefully, we get a little bit better turnout, and you could sort of focus on what I have to teach you today, which is about how to trade order flow the smart way. You always hear the saying. Um, don't work harder, work smarter, right? And the same thing applies to trading, right? You want to, trade smart, I guess is the way to say it. Use the resources that are available to you as a trader, right? To take advantage of, basically the information that's put out there in the market for you, the trader. So, there's no question that information is one of the most important tools in any trader's toolbox, right? I mean, you all heard of people going to jail for insider trading, right? That's how valuable information is to traders. Now, I'm not saying that we're going to be using inside information. We're going to use information that is derived from the actual trading that takes place. So, the best way to make informed decisions is to use up-to-date data, right? What's happening right now in the market. And, sifting through all that available information can be a daunting task, especially for new traders. So that's why I'm glad you took the time to join me for this quick training session. And in this session, we'll explore some of the best ways to find and use the information that's available to you as a trader to improve your trading. So what you're going to learn today is, the tools to make analyzing order flow simple, right? Everyone thinks order flow is some mysterious new thing. No, order flow has been around for, well over 100 years. Some of the greatest books on trading, Reminiscence of a Stock Operator, the guy was an order flow trader, and that was in the 1920s, right? 1910s, 1920s, right? Order flow has been around for a long time. It's not some new buzzword. It's just taking on, sort of different shapes as more data becomes available as to the traders. And I'm going to show you how to get an edge by tracking the trades taking place. All right. I mean, really, to be successful in the market, one of the things is you have to have an edge. You have to have an advantage over other traders because, if you're all trading on a level playing field, well, who's going to have the advantage? No one. It's just like flipping a coin, basically, right? Everyone, you got an equal chance. But if you can sort of put your thumb on the weight and give yourself a little bit of an advantage because you know how to read what's happening in the order flow, then happy days. And last thing I'm going to talk about some easy to see trade setups in the order flow. Now, again, the thing with order flow is you have to understand what you're looking at, right? You don't expect to just sort of sit down in front of a footprint chart or a dome or even time and sales and think you're going to figure it out. It doesn't work that way. You have to learn it, right? You have to understand what you're looking at in order to trade it. Now, for those of you that are new to one of my presentations, my name is Michael Valtos, and I've got over 25 years of professional trading experience. I started on the CME floor, the Chicago Mercantile Exchange floor, in the early 1990s with Dean Witter. And then when electronic trading started taking off, right, the early days of Globex, Project A, NYMEX Access, I left the floor to work on the upstairs trading desk because, I was, in my 20s, I liked computers, and I thought, you know what, this is the area I want to get into. Even though I love the whole open outcry activity, I thought that this could be, my niche in the market because, these were the same markets that were trading on the floor, but they're trading at night, and it had, um, a smaller participation by other traders. And I thought, if I could be successful at that, I could have a good career. And it did. That's what launched my career. After a few years at Dean Witter, I joined EDF Man in Chicago on the global macro futures trading desk, where we traded every imaginable futures contract you can think of that's out there. South African white maize, Japanese red beans, palm oil in Malaysia, everything, Baltic Freight Index. Then after that, I joined Commerzbank, the big German bank, back when German banks were big, as their licensed Eurex trader. I was one of only about a handful of people in the United States that were legally allowed to trade on an actual Eurex terminal in the United States. It was because the Chicago Board of Trade said, hey, you know what, we don't want, this foreign competition coming in, and so they stopped it. But if you already had the license, you were able to do it. After that, I joined Cargill. I was head of futures trading desk in Chicago for Cargill. I spent 4 years there. They eventually sent me out to Singapore to set up a futures trading desk when the SGX exchange, the old Cymex exchange, was decided to go fully electronic. And after setting that desk up, I joined JP Morgan as I was vice president of futures trading. I spent 8 years there. After leaving JP Morgan, I took some time off. I needed to recharge, because this had spanned from, the early 90s into, 2013. And I just needed some time. So I started writing a book on trading, which I'm going to show you how to get my book for free. You could just download it. And eventually I started my own software company because I was trading for myself, and the software that was out there was just basic, right? It just gave you a basic order flow footprint chart, but I know that computers can do much more. They can help you in your analysis by pointing and highlighting certain things out to you that you might otherwise miss, right? You could program, you know that. You could program signals to appear if, XYZ happens or ABC plus Q happens. And, this is how I was looking at order flow all these years. I'm like, hey, you know what? I found a programmer, said, hey, put it in the software. And that's what we did. We created Order Flows Trader, which runs on NinjaTrader. People ask me, why NinjaTrader? Why not Sierra Charts or something else? Well, it's because, that was one of the handful of stable softwares at the time that you could actually do programming for. And my programmer, understood order flow as well. So, it was like the perfect fit. And since 2015, we've undergone many, many upgrades. We're on order flows 6 right now, because over time, markets are developing, and there's new information that's available to traders by analyzing what's actually taking place in the market. Okay, so that's my background. So hopefully you can understand what I'm talking about and why it makes sense. Right, a lot of these tools I developed to help me for my own trading. Now again, the charts and tools used in this training are generated from my order flow software, but what I'm showing you today can be applied with other order flow footprint software if you know what to look for. Okay, and I'm going to sort of go through that, and I'm going to show you why using software can help you see things quickly and easily in the order flow, so you could add it to your own trading. Now again, brief disclaimer, we're all adults here. Risk capital is money that can be lost without jeopardizing one's financial security or lifestyle, right? And we've seen it recently with what's going on in the crypto space with these exchanges and everything happening. It's bizarre. It's like every couple months there's some bigger thing exploding in the crypto space. Don't put all your eggs in one basket, so to speak. I trade futures. I do dabble in crypto on the side. Fortunately, I'm in mostly in cash, except for some little altcoins. But you can't just put everything in one thing, because if you're going to be trading, right, or investing, do it with capital that's separate from your living expenses. All right, we all understand that. So one of the most important things to understand is your advantage, right? Getting your advantage in the market. And where does it come from? How can you create and maintain it? Because without an advantage, trading becomes little more than gambling, right? If everyone is on an even keel, or maybe your opponent, the person you're not really trading against one-on-one, but the other people that you're trading against have access to better information or better tools, they're going to beat you. They have an edge, right? Just as a casino has a built-in edge on all their casino games, right? So it's actually not it's not 50-50. You're actually maybe 40% against 60%, right? Because at the end of the day, these hedge funds, even the banks, obviously, the sovereign wealth funds, they have almost unlimited financial backing to invest in the latest technology and give them, extra speed on execution, extra forms of analysis. And, that's what we're competing against. So we want to try and level the playing field as much as possible. So what I'm going to talk about first are tools to make analyzing order flow much simple. So think of it this way: an order flow footprint chart This is a method for keeping track of all the trades that happen, and it's like having an organized workbench versus a workbench where you just throw all your tools, right? You know where everything goes, and it just all makes sense. You need this type of wrench, you know where it is. You need this type of screwdriver, you know where it is. This type of drill bit, you know where it is, rather than sort of digging through, different bags trying to figure out what you need. So on a basic sense, order flow derives from the time and sales, right? A trade takes place, it shows up in the time and sales. Right? We've all seen these time and sales charts like this, where it just shows the time, it shows the price, it shows the quantity. Now, honestly, it's not much use when pretty much every trade that goes through is one contract, right? You need a way to sort of take that information you're seeing on this time and sales and putting it onto a chart that's usable. The footprint chart is very usable because it's going to give you information. It's going to give you the volume traded on the bid, the volume traded on the offer at a price, right? It's going to allow you to see what traded in the two-way auction between the bid and the offer. It's going to allow you to see, where was more trading taking place? Was it more trade taking place on the bid, or was it more trade taking place on the offer? Was there an imbalance between the trading taking place on the bid versus the imbalance, or versus the volume trading on the offer, which would cause an imbalance? Or you could see maybe there was heavy volume traded on a bid or heavy volume traded on the offer, or maybe there was practically no volume traded on a bid price or no volume traded on. All this information is useful to us as a trader. And remember, markets trade in a two-way auction. There's traders bidding, there's traders offering. These are what's called passive traders, right? It's not just everybody's bidding. No, you have buyers, you have sellers, okay? And at the end of the day, bids and offers don't move the market, right? You need someone to cross over. There needs to be aggressive traders, traders who cross the bid and offer to get a trade done, traders who buy the offer, or traders who sell into the bid. Those are the aggressive traders. And think of it, on a very basic sense. Okay, so say you want to buy a car, you want to buy the new Corvette, 100 grand, but you don't want to pay 100 grand. I mean, now you go to a car dealer, the sticker price is 100 grand, but there's very strong demand. Even though the sticker price is 100 grand, you go to the dealer, say, hey, it says 100 grand, I'll pay for it. I'll pay 100 grand. When the dealer says, oh no, it's actually 110,000. Okay, so you thought the advertised price was 100,000. It's actually 110,000. The bid is 100,000. They'll laugh you out if you try to bid 80,000, 90,000. Your bid is 100,000, but the offer is 110,000. So if you really want that car, you got to pay 110,000. Now, if all of a sudden Chevy said, hey, we're going to ramp up production of Corvettes and we're going to have a lot of supply, we're going to make an extra 10,000 a year. You go in there thinking you're going to pay 100,000 for this Corvette, thinking maybe there's, some supply issues, but the Corvette dealer knows that, Chevy's going to sell a lot, then the dealer will just hit your bid instantly. Okay, so he's the aggressive seller, whereas if there's a shortage, you got to be an aggressive buyer. So by tracking the order flow, a trader's able to see which way the market's moving. And what you want to look for oftentimes is what the aggressive traders are doing, because the aggressive traders are what causes the markets to move. Is there a lot of supply in the market? If there is, then the people that have the supply will be aggressively selling it. They'll be selling into the bid because they know they got more to sell. Whereas if demand was very strong, you'd have a lot of people lifting the offer, buying the next offer price, buying the next offer price. Now on a dome, right? Dome was sort of the next step up from time and sales, where you could see, the depth of the market. You can see the resting liquidity in there. But the resting liquidity is are the passive traders. They're the passive buyers. They're the passive sellers. Now the problem with this, I mean, you can infer certain actions from the depth of market, or a book map or a heat map, but these aren't trades yet. These are intentions of traders. They've got some to sell at a price, they're going to work an offer. Oftentimes the market sort of comes up towards that price, they pull their offer, or if they're bidding, they'll pull their bid. Now, the difference between passive traders and aggressive traders, passive traders are willing to wait for the market to come to them. Aggressive traders cross the bid offer, meaning they hit the bid, they sell into the bid, or sell at the market, or they buy at the market, or they lift the offer. Okay, so all this information, this trading that you see in here, right, shows up in the time and sales, but it also can be formatted into a different type of chart, the footprint chart, right? It takes all that information, that all the stuff that you see trading on here, and puts it into a format that you can analyze. Now, these are actual trades. The difference between a dome is these aren't actual trades yet. I mean, they might trade these price, or it might go higher, it might go lower. But when you're looking at a footprint, these are actual trades that took place. Okay, you can't deny that. Um, at 40.11, there was 236 traded on the offer. Okay, that's fact. Okay, whereas if you're looking at a dome, bids and offers get pulled all the time, right? And even if you see big size, it doesn't mean it's going to trade. And what's more important, do you think? People's intentions, or what people actually do in the market? Excuse me. Well, what people actually do in the market is going to be more important, because now they have a position on, right? They have to manage the trade. They have to manage their risk. When you're looking at a dome, the market's 53 and a half, and someone's working, 200 at 55. Okay, yeah, we're a point and a half away. Of course, I'd love to sell it at 55 if I could. Maybe the market will tick up there and I'll get some. But if the market starts ticking up to 53 and three quarters, four and a quarter, maybe that person that was trying to sell it at 55, he backs off to 56. Okay, so yeah, he wants to sell, but maybe he's thinking the price is going higher. So that's what you got to deal with when you're looking at a dome. You got to be dealing with constantly changing bids and offers. Whereas you're looking at a footprint, it's not changing. Once it prints there, the bar closes, the footprint's not going to change. That's it. That's history already. That's the fact. So when you format the data into an order flow footprint chart, you can now see not only the volume traded in the toy auction, but you can determine the aggression that's taking place, or again, not taking place, right? We spent a lot of time talking about the aggression that's taking place, or the trading that's taking place, but you should also pay attention to when there's sort of lack of aggression or lack of volume taking place. Now, a normal candlestick chart can be very misleading, right? We think, a lot of times traders come into trading, they look at first a bar chart, but then they see a candlestick chart and they think, wow, this is the greatest thing. I got color on my charts. I could see, price opened up and closed higher, that's green, or price opened up and closed lower, that's red. And I see, I see this wick here. It's telling me, maybe prices are rejected. A lot of times you're just guessing that prices are rejected. And it sort of leads, in my opinion, traders into this false sense of security in that regard, where so they're like thinking, oh yeah, this is it, right? I'm gonna make $1 million, right? I'm gonna say, well, I got my nice bearish engulfing pattern here. Well, what happens? Market went down and then it just went sideways. Okay, and you see candlesticks are nice when they work, but oftentimes, at best, maybe they got a 50% chance. I mean, there's been studies on these, and honestly, it's not as strong as people think. Now, like I said earlier, when a trade takes place, it shows up in the time and sales, right? That's what the time and sales exists for. The time and sales existed, you know, forever because this is how people would look, check the integrity of their trades. In the old days, you used to be able to, when you'd have to call a broker to trade. Now we all do it ourselves. But you'd call up, and then you'd check the price, the fillback that you got from the time that you entered it to the time you got it back, make sure it traded in there. That's how people used to use time and sales in the past. But the smart traders, they would watch it, right? Because they could see the price, they could see the volume at the price, and they could see if the trade took place on the bid or the offer. And people say, why is that important? All I want to know is that it traded. Well, let me ask you, knowing if the trade took place on the bid or the offer, do you think that's important information? Well, if you know that you have a lot of people buying the offer, right? Because remember, markets trade in a two-way auction. Say it's, 53 at 53 and a quarter, and everyone's buying quarters for a lot, and it gets through there, starts trading halves for a lot. That's good information, right? If it just trades halves for small, okay, fine. Market's just trading, right? That's what markets do. They spend most of their time just facilitating trade. But then when you start to see things happening, volumes starting picking up and big volumes at certain prices, that's going to get your attention. And if you're looking at a normal candlestick chart, right, you're not going to see how much volume traded here or anywhere in the bar. You're just going to see that price traded there. So what information really is the candlestick giving you other than the open, the high, the low, the close? I know people will see those wicks and say, oh, you know what, there's price rejection. Well, there's price rejection here, price rejection here. Every bar, just because you have a wick doesn't mean that there's price rejection. But on the footprint, that's where the rest of the information is. You could see where the aggressive traders are or lack of aggressive trading. You can see where the aggressive trading has been getting weaker, as the market has been moving. Or you can see if there's volume in there to stop a move from going any higher, things like that, right? So for example, we're up here near the high of the day. This is yesterday. High was what, 17 and a half. You come up here, hit this double top, and you can see it's mostly negative deltas in here. It's all red, which delta tells me, the net difference between aggressive buying and aggressive selling is telling me there's aggressive sellers up here at the high of the day. If you're looking at a candlestick chart, you don't know that there's aggressive sellers up in here. From here to here, most of this is aggressive selling taking place. But if you're looking at a footprint chart, it's obvious, right? It's obvious that you see all the negative deltas. You want to be position yourself to the short side. Don't be looking for the market to pop up to new highs. Why? Because we got a lot of selling taking place. You got a lot of selling. You want to be positioned short. So from that time in sales, right, I sort of just alluded to it. You begin to create the footprint chart, right? This is your footprint chart. And on there, you're going to have a lot of information. You're going to have delta, max delta, min delta, cumulative delta. Now, delta is the difference between aggressive buyers and aggressive sellers. That's the normal delta. Max delta is how strong aggressive buyers were in a bar. Min delta is how strong aggressive sellers were in a bar. Cumulative delta is, up to that point in time is, the aggressive buyers or are the aggressive sellers in control. Now, point of control is the price level in the bar that has the most volume. And this is important because, as price is moving, you want to see volume move as well, right? So if price is going up, is it going up on light volume or just average volume, or is it going up on strong, heavy volume? When the market is moving with strong volume, meaning higher prices, heavy volume, chances are we're going to go higher because, markets are always looking for liquidity. And if you're taking out the liquidity and looking for more, chances are we're going to continue in that direction. And also you can see where imbalances occur in the market. Markets often move from balance to imbalance to balance again. And if you know that you're in a period of imbalance, that's going to give you a great opportunity. And the best part is you're using the data generated from the trading that's actually taking place right now in the market, right? You're basing your decisions off of what's happening now. So you want to use information that's going to add value to your trading analysis. What do you think is going to be more useful? Just knowing the open, the high, the low, the close, or knowing when and where the aggressive trading is taking place, or when volume is migrating higher or lower? Are aggressive traders active or not, right? So what is the market telling you? This is our chart. Well, obviously we got the negative deltas telling me aggressive sellers are in control up here at the high. Well, then you start to dig a little bit deeper. You can see the max delta, right, on these bars. They're very small, 2, 5, 1. So even though you're up here near the high, you're at a high. Normally you'd expect to see euphoria. You'd expect to see people wanting to get this market to go higher. But if aggressive buyers were never really in control, it's just been dominated by aggressive sellers, that's a bearish sign, right? It's pretty obvious. Then you're seeing the selling imbalances coming in. You're seeing points of control start to move lower and lower. I mean, you do have one that pops up here, but since this high, it's lower, it's lower, it does pop up here, then it's lower again. And then you come in here with some big, strong, more negative deltas before the market finally starts to sell off, right? There's so much information that you can get off a footprint chart that you're just not going to get off a candlestick chart. All right, so the second part that I want to talk about today is getting an edge by tracking the trades taking place. And it's like, I'm outside here in Chicago, and today we got our first, big snowfall. And I could already see, in my driveway when I was getting the car out, I could see that there's some little animal tracks. And I know I got things like raccoons. Where I live, I've got all sorts of wild animals. I've got raccoons, possums. Obviously, I got all these different birds, but I got deer. I've got coyote, fox, and I've taught my kids, look at the tracks, right? Because if you learn what animal the tracks go to, because you don't want to be following a track for a coyote, right? But it's no problem to follow the raccoon tracks, right? Raccoon's not going to really bother you, and there's a big difference in how they look. And just as on a footprint chart, the order flow footprint chart, which is aptly named, I didn't develop it, other people developed it, and God bless them. I think it's the greatest thing out there as far, to help traders. But you can sort of see that with the different type of trading taking place. So by tracking the trades that are taking place, you can gain insights into the movements of the markets. And this is the information that's going to give you an advantage or edge over other traders. Why would you want to track the trades taking place? I said, why do I got to do that, Michael? Well, you want to know that you know, you don't have some big animal or shark about to come in and bite you. So there's several ways to track trades in the order flow. Now, I talked about delta imbalance POC. I'm going to spend some time talking about other information that's derived from the order flow, value areas, and volume at price, which is just as important because that's what's going to help you find good trades, trades that have low risk with some, strong upside potential, and you know, trades that other traders aren't going to see because they're not looking at order flow. They're just looking at, a simple one-dimensional chart, right? The open, the high, the low, the close. Whereas now you're able to have a more three-dimensional picture of what's actually happening by analyzing what's happening, trading on the bid and the offers in the market. So again, time and sales, when a trade takes place, shows up in the time and sales, but you can take this information and analyze it deeper. So the first one is delta. Again, it's the net difference between aggressive buyers and aggressive sellers in a bar. It's a quick way to see who's in control, buyers or sellers. So sometimes, it's pretty evenly matched. Markets weren't existed for speculation. They were created for um, people to hedge risk, basically hedge their crops, so to speak. And oftentimes trading is generally evenly matched, right? Because that's what the market is doing. It's transferring risk, it's facilitating trade. But there's a speculative component. And you want to see, are traders taking a position because maybe they think, the weather is going to change or a certain, the inflation number is going to change or the job number is going to change, etc. And, delta's a quick way to see who's in control, the buyers or the sellers. Now delta, right, is going to be basically the difference between in every bar is going to have a delta. It's going to be the net difference between aggressive sellers and aggressive buyers. And on my chart, it shows up on the bottom. You also got the max delta and the min delta, again, which shows how strong aggressive buyers were in a bar, max delta. And again, max delta would always be positive. It could be 0, meaning they were never in control, or you can see here like 1 and 2, meaning they're only in control for like a split second. Or the bars that have strong min delta is telling you that aggressive sellers were pretty much dominant in the bar. Now, min delta would never be positive. It'll always be negative. It could also be 0. Okay, meaning like here's a 0, means that, you know, aggressive sellers were never in control of this bar. So that's the delta, right? You're measuring the difference, the net difference in aggressive trading taking place in a bar. Now, imbalances is when the aggressive trading, you know, what's trading in a two-way auction, is not roughly equal. I don't want to say, um, you know, I chose that word specifically, roughly, because generally trading, it's never as simple as people, you know, in the academic world think of it as, you know, every buyer there's a seller. Well, yeah, but you're not really looking at buyers and sellers. You're looking at aggressive buyers and aggressive sellers, and more or less they are roughly equal most of the time. Now, you do have what's called imbalances, right? When what's trading in a two-way auction, you know, one side is more dominant than the other side in the two-way auction. So say the market's 6 bid at 7, but 300 traded at 6 and only 25 traded at 7, you'd have an aggressive sellers in control. You'd have a selling imbalance. So imbalances are a way to determine who is dominating the market right now and how strong they are dominating. Because an imbalance by itself is one thing, but when you start to see, you know, imbalances strung together, like here's a bunch of selling imbalances in this bar, it's telling you, you know, maybe there's a big order going through, or you know, there's a bunch of traders coming in thinking this market is going to go lower, just as you have, you know, these buying imbalances, right? You got 1, 2, 3 here, another 3 here. It's telling you, hey, you know what? Traders have sort of abandoned what was happening earlier. Now they're jumping on the long bandwagon and they're FOMOing into this market, right? You might want to be trading it to the upside. Forget about thinking that this market's going to fall back down again, because now you have buying imbalances appearing. And think of imbalances as sort of the current of the market, right? Like current in the river, right? You don't want to be swimming against the current because it's going to be very difficult to move, let alone go forward, because you're fighting it. And the same thing with trading. If you're seeing a lot of imbalances appear in the market, don't fight it, right? You go with it, right? If you're trying to get long in here and there's strong aggressive selling, you know, you got 1, 2, 3, 4, 5 imbalances, it's going to be very difficult for this market to go up because it's not you against the market. Once you get on a position, there's nothing else you can do, right? Everyone's still going to keep trading. So if you're getting long in here at, you know, 4,000 and, you know, at 01, at 4,000, at 99, even at 98 and a half, there's selling imbalances and you're long from 4,000, you can't do anything else. But there's still a trading going on. You still have the aggressive sellers coming in. You're fighting all that strong selling that's causing this market to go down. So you're going to lose, right? You're going to lose in that respect, just as, you know, on the way up, right? If you're thinking, oh, you know, we've rallied back up to our previous level, I can get short, but you're getting short in front of a bunch of aggressive buying. Not the smartest thing to do. Now, that's not to say that this market can't fall over. Of course it can. Things can change and aggressive selling can come in. But if you're thinking, hey, you know what, I'm going to get short here at 99, which is just opposite where all that aggressive buying was taking place, and even down at 97, there was more aggressive buying. Why? Right? You're going upstream, so to speak, right? You're going against the current of the market. Don't, right? You're fighting a losing battle. Yeah, sure, you may win here and there, but chances are the market's going to keep going up because aggressive buyers are now in control. Now, point of control, right? The price level in the bar with the most volume traded on both the bid and the offer. Now, this is not in the two-way auction. This is in the bid and the offer. And it lets you, it's a crude way of letting you track volume, because you want to be asking, is volume following price or is it diverging from price? Is price going higher, but is volume also going higher? Right? Generally, what you expect to see is when when price is moving higher, you expect the volume to also be moving higher, because that's what's going to sustain the move. When you have price go higher on very light volume, it often retraces back from where it came from sooner rather than later. When you see price go lower, expect to see volume go lower as well, right? On strong moves. Price can drop on very light volume, but then you've seen that where price just bottom just falls out, then it comes right back up. Then you look at the volume and it's very small volume. So that's where things like point of control and volume is going to help you as a trader, right? And you can see as price is moving down, from up here, right? This is your swing high. We're moving down more or less. Volume is each bar is migrating lower, right? Just that was start going up. Volume in each bar, the point of control is moving higher. Now value areas. Now a lot of traders already know the term value areas, right? It comes from market profile, and it's the area on the day where 70% of the volume traded. But you can actually look at value areas on individual bars. And whether you're looking at a 15-minute, a 5-minute, a 100 tick chart, 500 volume, 1,000 volume, whatever, you can still get the value area. And it allows you to see how value and balance is forming. And more importantly, allows you to see when the market is moving away from value and moving away from balance, which is all important information for a trader. And on my software, again, I'm hoping that more softwares start to allow you to do this, is put the value areas on the bar, because you're going to start to see things happening that you would never see otherwise, right? Just looking at a normal bar chart, you know, you could see how a bar opens up relative to the previous bar's value, how it trades relative to the previous bar's value, how it trades relative to its own value, right? You can see up here, right? We got value that's overlapping, right? We formed this balance area. Now we're starting to break away. You see a gap in value here. We see another gap. Market comes down, makes that swing low. Now market starts moving up. We're seeing value move higher. It says point of controls are moving higher, but more importantly, value area highs moving higher for each one, one bar, 2 bar, 3 bars, 4 bars, 5 bars. It does dip down here and then gaps back up, right? And we just keep moving up, right? So that's how value areas can help you. It's sort of going to give you another way to look at, is the market balancing, right? Like it is here when you're forming, 1, 2, 3, 4, 5, 6, 7 bars overlapping in the value area. Here, right? We're balancing in here. You got 1, 2, 3, 4, 5 bars overlap. But it's when you start to see the market move away from this balance area, that's your trading opportunity. Just as here, market's moving away from this balance area down. Okay, so value areas are something that I think for traders that are struggling with other aspects, looking at where value is trading and where it's forming, where balance is forming, is going to give them, it can be a game changer. So something you should pay attention to. Now, volume at price. Now, obviously, to see volume at price, you can't be looking at a candlestick chart. You need to be looking at a footprint chart, an order flow chart, because you're going to be looking at the volume traded on the bid and the volume traded in the offer. And if you're looking at a dome, it's going to be hard to track, right? Unless you're like Rain Man or something and can process all those numbers instantly, then it's going to be hard. That's why we use an order flow footprint chart to make it easier to see. So by watching and understanding the volume trading at price, you're going to be able to determine where the big traders are active. And you're going to want to pay attention to the volumes that are bigger than normal. And again, it's not always where the volume is big. It's also where the volume is light. Things like that is where you also got to be paying attention to. Okay, so for example, what you have here in this bar, at the bottom of the bar, volume is very light. Okay, there's lack of trading interest at these lower levels. Market is going up, sort of pulls back down, starts going back up, and as it goes back up, it leaves this footprint, so to speak, the animal tracks of very light trading. Traders aren't interested in selling anymore down here. So if they're not interested, what do you think the market's going to do? Well, chances are it's going to go up, right? This is interesting. It might be a little bit hard to see on your screen from here, but I'll just read the numbers to you. On this footprint chart, the biggest volume that's taking place is right here, 274. It's taking place on the bid side at 92 3/4. It's 274. The biggest on the offer side is 265. And then you got 238 here. But down here you got 213. So where's your heavier volume? People are gonna say, well, it's traded here on the offer. But, well, actually, your heaviest volume is on the bid side. So it's telling you there's strong support coming into this market. Right? If this market is going up and you see a strong bid coming in, that should be connecting to you. Say, hey, you know what? Market came in here, made a swing low, starting to go up, and I got a strong bid coming in off the low. And this goes back to, the old floor trader days. The guys on the floor can know that when a market is made a low and all of a sudden they see the big houses, the Goldmans, Solomon Brothers or whatever coming in, bidding the market up, they know to get long. And the same thing on the footprint chart. If you're able to see where there's a strong bid coming in on a market that's going up, that's a pretty safe trade. Now, that's not to say that it can't fall over. Of course it can, but you have a piece of information. You know that bidders are coming into the market off of a low. That is information that's very useful to you as a trader, right? You should be able to, I don't even need to explain it. I mean, that should be just common sense 101. Made a new low, buyers are coming in. What do you think is going to happen? Market's going to go up or make a new low? Obviously, you're going to expect the market to go up. So every advantage counts, right? And one way to give yourself an edge is to track the trades that are taking place. By following the money, so to speak, you get a better sense of where the smart money is flowing and trade accordingly. Every edge counts, whether you're trading or whether you're playing poker or whether you're playing sports, right? For you guys, the fellow American football, right? Tom Brady, right? He thought he had an edge. He's quarterback. He's not a wide receiver. He went to go catch the ball, but he slipped because he didn't have the right cleats on. Because for his position, he doesn't really need to run around a lot on the field. But when he was, that day that he ran out for the pass, he turned around and slipped because he didn't have, he was playing on a sort of a level playing field. He didn't make that advantage of saying, hey, you know what, maybe I should swap out my cleats or something. So wide receivers understand that. They wear the gloves, they wear the cleats, right? Every little advantage counts. If it could make you jump a half an inch higher than the person you're playing against in basketball, that's an edge, right? And in trading, the same thing. Have an edge. So the third thing I want to talk about, it says number 2, it's actually the third, is easy to see trade setups in the order flow, right? I like to keep things as simple as possible. There's no sense in trying to make things harder than they need to be. Sometimes people like to make things harder in life, and there's no point to that. Keep it simple, easy to see, easy to spot, easy to trade, right? The best trades are the easiest trades. We don't know that until afterwards. But one of the benefits of using order flow is that it can make trade setups much easier to spot. When you know where the orders are coming in and going out, you're going to get a much better sense of where the market is likely to move. So I'm going to talk about some easy to see trade setups in the order flow when you have the right tools. And when I talk about tools, I talk about a footprint chart. Specifically, I'm going to talk about the next level, the order flows trader chart. I'm going to show you the examples. I'm going to explain the logic behind them. So even if you don't have my software, hopefully you can be able to spot them. Now, if you do have my software, it's incredibly easy to spot these trade setups. So it's market sweeps, there's value, nope, not value gaps, it's tails and market weakness. So first one is market sweeps. Now, a sweep is a type of trade that is typically executed by a large trader who has a large order to fill and wants to do it so quickly. Now, to execute a market sweep, the trader will typically trade through several levels in the market, buying all the available contracts at each level or selling all the available contracts. And this can have an effect of pushing prices higher or lower if he's selling, obviously higher if he's buying. As that big trader's order removes liquidity from the market, right? Bids and offers are liquidity, and what you have in a sweep is a trader removing that liquidity. Now, market sweeps are a legitimate trading strategy that can be used to fill large orders quickly. And, for most of us, retail traders, I consider myself now a retail trader, but I was on the other side. I was a professional trader for a long time. You got a big order, you need to get it done, market's moving, you just sweep the market. You buy whatever liquidity is there, or you sell out whatever liquidity is there. Now, you're not going to do it all the time, but when you're in the heat of the moment and you know the market is moving quickly, trying to finesse an order is going to cost you a lot of money because the market's going to start moving away, especially if the market gets wind of what you're trying to do. A sweep is instantaneous. It just goes through all the levels that you set it for and buys or sells everything in its way. Now, sweeps are considered to be aggressive trading tactics, and they're not used by small traders as it requires size. I mean, yeah, we could sweep through the market on our 5 lot, and most markets it's not going to matter. Maybe if you're trading something like, I don't know, lean hogs or something, you could sweep through the market with 5 lots at certain prices, but if you're not going to do it in the E-minis, that's just going to get absorbed really quick, or crude, or any of those major markets. So while market sweeps provide a trader with better prices, they also create more volatility in the market and cause prices to move away from the levels where other traders are trying to execute their trades. Because, if you're there, say the market's, 6 bid at 7, you're working sixes, trying to buy sevens, thinking, you know what, there's 200 on the offer at 7. If it gets down to, 75 or less, I'll just go pay 7. But so you're sitting there, trying to work your order, but there's some big trader, another firm, he's got 500 to buy. It's only 200 offered at 7, 200 offered at 8, and 100 offered at 9. He's just going to pay 9 for all 500, and next thing you know, it's going to be like 9 bid, or maybe there'll still be 9 offer, but the next thing you know, it's 8 bid. And so you're trying to buy your sixes with a tick to pay 7. You got nothing, right? So that's what happens when sweeps take place in the market. Now on on a bar chart, you're not gonna be able to see where sweeps take place. Are you not gonna tell, oh, is there somebody trading through several levels at once on one big order? You can't. Anybody that tells you they can see that on a bar chart is just talking nonsense. Now on a footprint chart, you can see it. So this is a Euro currency, a 5-minute chart. And you can see, market was coming into these lows, then the market sort of went parabolic there. Well, wouldn't you like to know maybe some information that, there's some market sweep went through the market? Well, if you have a software like my order flows trader, we have this function on here called market sweep detector. You just click it to enable it on your chart, and it will highlight to you here, right? There's this a sweeping activity taking place in the market right before it shot up. Right. This is crude oil. Okay. This was yesterday. Well, these charts are from yesterday. Sold off basically 89 even, 89 bucks, all the way down to, this is 86 bucks. This is a 5-minute chart. And we're talking from, about 9:50 to about 11:30. So just not even 2 hours, right? Just about an hour and a half. It had a $3 sell-off. Wouldn't you like to know, what information up here can tell me that this, because we just had this big giant green bar up, right? Very bullish bar. But then it started turning around, oh no, oh no, oh no, 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 no. But on the footprint, you could see there was sweeps taking place here. There's actually in this other bar, there was more sweeps taking place. But this is coming off of this swing high in here. Now again, you could add your other analysis to it, like what's point of controls doing, what's delta is doing as well. But having, some information telling you that there's sweeps taking place. Now, obviously on this big bar up, you got a couple of sweeps. Okay, it's a big bar up, wide ranging bar from, 88.30 all the way up to, 89 bucks, 70-cent range. Okay, it's not uncommon to see that on big wide ranging bars, but now we sort of peaked out, starting to come down. And now you're seeing to see bearish sweeps take place in the market. Now you could also draw out these zones if you like. kind of mixed. Some people like to just have them in the bar. Some people like to draw them out. This is the minis yesterday, right? 39.90 and a half area. You're seeing this sweep, this big bearish line being drawn out. And this was also yesterday. Came down into that swing low, started rallying. Again, another bullish sweep taking place in the market. Now, oftentimes with sweeps, they come as a result of stacked imbalances, right? In the E-minis at least, right? You can see here, these are also a stacked imbalance at that level. There's a stacked selling imbalance at this level. Here in the crude, these are not stacked imbalances in here. If you're looking for stacked imbalances, there are no stacked imbalances. This is a 5-minute chart in the crude. There are no stacked imbalances in here on this way down. On the way up, there's a stacked imbalance here. I think this was one a little bit higher. But on the way down, if you're thinking, well, I could just look for stacked imbalances, you have no stacked imbalances, no stacked selling imbalances in here. You would have missed those trades. Now this is the bonds. This is a 4-range chart. Now I have, with bonds, since it's a 4-range chart, I've adjusted the sweep level to just 2 because it's a 4-range chart, so there's only 5 price levels. But you can see we're up here near the highs yesterday. 123.28 was the high. You came back up, you got a bearish sweep here, another bearish sweep here, another bearish sweep. Before we finally broke down from, basically the 123.17 area down into, 123.04. It just sort of hung around down here. But the first sweep came after you hit the high, came off, made another run up towards that high, started coming off, you got the bearish sweep. Now, the second one I'll talk about is buying tails, buying and selling tails. So there's buying tails or selling tails. And they occur because traders get trapped in the market. They get caught off sides because they're too anxious to get into a trade and try and predict what will happen next because of greed, basically. They're getting greedy in the market. So instead of letting the bar develop and letting the trade appear, they end up taking a very speculative trade. And ironically, the actions of these anxious traders not just leave them in a bad trade, but to order flow traders, a good trading opportunity appears, a buying or selling tail. And again, it's based on the footprints left by these anxious traders. Now, if you're looking at a simple bar chart, again, you can't tell if there's tails. I mean, you have wicks, right? Candle wicks above and below most candles. They vary in size, but when you're looking at the actual order flow, the volume traded on the bid, the volume traded on the offer, it gives you a better insight as to, are traders trapped or not? And if you're looking at a normal footprint chart, you got to know what exactly to look for, right? There's a lot of information on here, and you might miss it. Now, if you have software, right, the order flows trader, it allows you to highlight buying and selling tails. So I can see here, I had a nice buying tail, right? So I know that this is a nice long entry. You see the market went up, came right back to that area where these traders got sort of trapped earlier and made another run. There's different ways to trade it, right? You can just get long immediately, or you could try to play a pullback to around that area. Now in this case, it just sort of came literally right back to it, to the tick. But oftentimes it may come within a couple of ticks on either side of that area. But these are bad, basically when they come in at swing highs, swing lows, it's a sign of bad structure, and the market will often repair bad structure. It's crude oil right here is a nice buying tail. Okay, what's happened is market, people got in, market was selling off. Hey, we gotta get in. Let's get short. And then the market reversed and went up. These guys are trapped down here. Now, for more volatile markets, right, that don't have the same liquidity as say the E-minis or crude oil, we have a couple of filters. You could check the value areas, the EVA, which is in a large value area, or check for higher highs or higher lows. So I'm going to show you, right? I had my program put this in because I like to use this on markets like NQ, MNQ, and YM. It's just an extra filter to show me, because the problem is All right, when you're looking at volume on volatile markets, you don't get a lot of volume traded at price oftentimes, right? You see these bars, it's a lot of ones and two contracts going through, which is much different than if you're looking at, an E-mini chart, which has very strong volume. So we added, an extra filter, the expanding value area, that's this blue one here. But you can see this is a tail appearing down here in a bar with that filter turned on for the uh, expanding value area. Here's another one. This is MNQ, right? Right down in here, market shot up. So, it's nice to have an extra filter in there for volatile markets. And people say, well, why you got to filter for volatile markets and not volatile markets? Well, markets trade differently. Generally, they trade the same, but they each have their own little nuance to them. Now, the last one I'll talk about is market weakness. Now, market weakness in the market can occur during both up and down moving markets. And this is due to traders becoming less and less interested, causing a lack of interest in a way. And when it happens, it's difficult to move the market any further in a particular direction. And as a result, we see prices begin to consolidate or reverse. Now, market weakness is kind of it's a term that I think gets misunderstood sometimes. Now, you're thinking of market weakness. Think of it as, a market is going higher and it's showing market weakness. What the weakness is the buying pressure, so to speak, the deltas or the aggressive traders is getting weaker as you're going higher. That's a sign of weakness. Even though the market's still going higher, people think, well, market's going higher. Why are you saying it's getting weaker? Well, the buying that's taking place on the move higher is getting weaker, just as the market is going down and the selling that's taking place is getting lesser and lesser till finally it dries up and there's no more selling, then the market's going to turn around and reverse. Now, if you're looking at a normal bar chart, again, can you determine where the actual weakness is taking place? It's easy to look after the fact, oh, it's getting weak up here. When we're trading down here at 70, when we're trading up at 15, the market looks pretty darn strong at that time. But obviously after a 30-point move, 45-point move, oh yeah, it was obvious it was pretty weak. Well, no, when we're up 40, it looks pretty strong. So you need a way to determine, and the way is use order flow. Right? And one of the ways you're going to start looking at for weaknesses in the deltas, right? Here's this market is going up. This is at 130, right? Where's 130 here? This move right here. Okay, so market has made its high, it's coming off, it's making a move back up. Sell the rally, right? Buy the dip, sell the rally. Well, is this your dip? You're going to buy some more, go up, or you're going to sell this rally? Well, if you're looking at the order flow, so the market's coming down, remember, this is your dip. If you're buying this, it's starting to go up, right? Oh yeah, I bought here, the market's going up. Well, are you supposed to buy this dip or sell this rally? Well, if you're looking at the deltas, as we're going up, deltas 400, 170, 160, 78, minus 14. Okay, go back. It's going up 400, 178, 163. I forgot what that was. 50, call it. Then minus 14. Do you think this move's still going to go higher? Chances are it's not. It's going to break because there's no more aggressive buying really happening. It was minus 70. So minus 412, plus 412, plus 170, plus 163, plus 78, and then minus 14. Then even here, it's minus 72, minus 500. So not only did it go from a little, market weakness going up here on this little rally, on the sell-off, it's getting quite strong. It's getting stronger. Okay, so what do you think the market's going to do? It's probably going to sell off, right? Which it did, right? Sold off, pulled back up, sold off some more. So if you have the order flows trader software on there, there's the market weakness detector. Okay, you just click it and it will draw the line on the chart for you. It's telling you up here, there's weakness taking place. Okay, you can draw these zones out until tested, like here. It came literally right back to the high of that bar where it detected the weakness first. So it makes it easy for you to see, right? You want to make life as easy as possible for yourself. Okay, again, if you're just looking at a normal footprint like this is gold yesterday. Okay, I mean, if you understand what you're looking at in terms of the order flow, maybe you could pick it up, right? I can see it in here, 15 minus 59, minus 6, minus 3, 89, boom. This is where the weakness, this is the selling weakness. We're at our high, even though we got these negative deltas, that aggressive selling is getting weaker. You're at your high of the day. You had aggressive selling coming in. It's not getting stronger. It's getting weaker. That aggressive selling is being absorbed in the market. And if that aggressive selling is getting absorbed, chances are we're going to pop higher. And we do. We go from 74 up to 78 pretty quick. This is a 1 minute chart. We're talking from 90, what is that? 908 to 918. 10 minutes, $4. Euro currency. Okay. After a while, if you know how to spot it in the order flow, then you don't need my software, but you've got a lot of stuff going on in the order flow. Wouldn't it be nice to sort of put two and two together, right? With markets coming down. You got aggressive selling, but the aggressive selling is just getting weaker and weaker, right? We're going sideways in here. You still have some aggressive selling, but it's weakening before the sellers finally give up. I got no more left to sell. And what are you going to expect the market to do? It rallies 103.30, basically up to 103.50. Um, on a tick chart, same thing, right? You're going to be looking at the same things, whether it's a minute-based chart, a tick-based chart, a range-based chart, a volume-based chart. This was E-minis yesterday around this 39.96 and a half area. You're seeing the weakness come in, right? And this quickly from 96 and a half down to, 92 and a half. Very quick from, they're talking 227 to 230. That's a quick move of 4 or 5 points in 2 minutes. Another one, right? It's a little bit earlier. This was at 9, just before 10 o'clock yesterday. Again, also a 500 tick chart. You actually got 2 bars of weakness. So market was going up, started selling off a little bit. This is a dip you buy. When you're seeing weakness coming in on the dip, that's the one you want to get long on. From 98 all the way up to 03. And again, we're talking from 954, 955 up to 958 in 3 minutes. 5 points in 3 minutes. So you've got your choice. Do you want to do things the hard way or the easy way? The hard way is try to figure it all out on your own. The easy way is have software that does a lot of the analysis for you, right? And nobody says you can't use software to give you an advantage in the trading world. People do it all the time. That's how they make money. And remember, this isn't rocket science. Now, there is some science to it, but it's not rocket science. So there's much more to learn about order flow trading that I can't cover in such a short training session. Now, I hope that you have a good understanding of order flow basics. And if you're interested in learning more, I have a special offer for you. You're going to be excited. It's the Order Flows Trader 6, which is the software you saw used in this presentation. And it's really like taking my trading brain, pumping it into the software to show you on your screen where areas of interest are in the order flow, right? It's all that information that I've gathered over 25 years of actual trading, right? I'm not saying, oh, I worked at JP Morgan, but I worked in the ops department or something. No, I sat on the trading desk. That's what I did. I go there at 5:30 in the morning before Globex opened up at 6 a.m. This was in Singapore. I'd be there until the Hong Kong closed at 4:15. Let's say until 4:30. So I did this for decades, right? Of just staring at screens and watching the order flow. Now, many people think that having the right software is all they need to be successful in trading, and it's not. You need to have software, yes, but if you don't know how to use the software, it's not going to do you any good. So that's why I provide a lot of education. I like to think I focus more on the education than the software, because I want you to be successful, and I know that It starts with giving you the tools you need to understand the market. And once you have a solid foundation, you can begin to place trades with confidence. And that's where the real success starts to happen, is having that confidence in your trading. So I'm gonna give you access to my order flows trading course, which I sell for $297. Right, you're gonna get it for free. This is the full course. You're not gonna get like a watered down. You're gonna get the actual course, and you're also gonna get access to my order flow inner circle video series, which the only way to get it actually is through the software. Right, I don't have like a sales page or anything like that. You can only buy it, get access to it rather, is through the software. But when I did, it was close to $500. There's 56 videos. These are not like 3-minute videos. These are like almost an hour-long videos of advanced order flow tricks, tips, and analysis. Right, that's going to help you become a better order flow trader. I see a lot of people say, "Oh, I got 120 videos out there." Then you look at the videos; they're like 2-minute clips. Now, maybe it's easier to digest, but with this Inner Circle video series, I took a main topic of order flow and I really dived deep into it. Now, software normally sell for $8.99. Trainings $297. The Inner Circle video series is $497. That's $16.93, but you're not going to pay $16.93. Now, one of the things that I've learned when dealing with retail traders is live trading helps, right? Or live training rather helps. And because it's one thing to try and learn from videos and books, but it takes commitment and it takes discipline. That's why I have a live training component, right? I mean, I've got a lot of books on trading. I'll go to a used bookstore, and first thing I do is go to the finance section. Any book related to trading, I buy. I've got literally hundreds of books on trading. Have I read them all? Yeah, I've read bits and pieces of them all, but it takes time, it takes commitment. That's why having a live trading training is something that's going to help you guys. And so for the past 3, almost 4 years, I've been hosting a live user training session for my users to join, where I drive home what I saw in the order flow this past week. You could ask your questions about areas you may be struggling with. You can even ask questions about your software, right? Mike, how do I do this? How do I do that? Yes, Mike, what do you think of this market? What do you think of this bonds on this type of chart? What should I be looking at? Mike, I trade a 5-minute chart and NQ. I don't like the way my chart looks. How can I streamline it? Things like that. Or, Mike, I have a problem with my license. Right? This is a resource. If you can't reach me on email, right? A lot of people say, "Oh, Mike, I can't reach you on email." Well, I have every Tuesday. I'm there in the session. You get an email with the link to join each week. The link changes, obviously, but you can go in there. You can ask me anything, right? That's why it's there. It's a resource for you. And if you guys, people, I've got users that have been attending these sessions for years since I started it. They're still doing it. I think there's close to 180 episodes now in there. And again, if you can't attend, you could watch the replay, right? And other traders, I've seen other quote gurus out there, they sell you the software, then they'll say, "Hey, join my special training session in this city." So they get a free trip to travel there, and they're going to charge you $1,000 to learn how to use their software. For what? I mean, you're already making the investment in the software. Come on, you know, it's pointless. I don't charge for this. It's a free access for everybody that has my software. Now, what I discussed today is just a small sample of the kind of analysis I talk about on a weekly basis in the live group training, and what can be found in my Inner Circle video series. I go into much more detail about all aspects of trading, from technical analysis to fundamental analysis. I talk about the different trading strategies I'm using, how to adapt them to changing market conditions, and much more. So if you're serious about trading, then I highly recommend you get started now. You'll learn more about order flow in the weekly sessions than you probably thought possible, right? I do post videos up on YouTube, but really, the juicy stuff is in the training sessions, each week's training sessions. And again, it's a resource for members. So to get started, go to orderflows.com/oft6, OFT6.html. I put it in the chat already. And you come to this page, just scroll down on the page. Now there's videos and things you could watch on there. I got a special deal right now. It's still $7.49. You can get access to the Order Flows Trader 6 software, the Order Flow trading course, the Inner Circle video series. You can get access to our live weekly group trainings, plus all the recordings going back for several years. I don't expect you to go through all of them at once. And you get access to my special bonus, the Order Flow Playbook trading course. Right now, when you click on this button, it takes you to PayPal. PayPal processes your payment, and all of the download information is going to go to your PayPal registered email address. So whatever email you enter here to log into PayPal, that's where it's going to get sent. And since I give you access to a lot of extra training, it does take time for your payment to process and for us to generate your logins for the Inner Circle video series, the training course, and my special bonus, the Order Flows Playbook. Now it's just a one-time payment of $7.49. No monthly recurring payments or any other payments in the future. Now, of course, you'll need to pay your Ninja data fees, and if you're not on a paid version of Ninja Trader, so you still got to pay. You do need a live data feed. Now, if you're first time using Ninja Trader, when you sign up for Ninja Trader, you can download the free version. They'll give you a 2-week trial of real-time data. So you get started with that. Now people say, Mike, I don't use Ninja Trader, I use TradeStation. Can I use this on TradeStation? No, it runs on Ninja Trader. But what you can do is you get Ninja Trader. My software will run on the free version. You just open up an account at Ninja Trader Brokerage, fund it with a couple $100, and you get a real-time data feed at a much reduced price than going to an actual data provider. And I think CME is like $100, Board of Trades 100, NYMEX is 100. If you have a real-time data feed, you only need level 1. You don't need depth of market, which is level 2. You could get CME, CBOT, NYMEX, real-time data feeds through, Ninja Trader Brokerage. You're only going to be paying around $50 a month as opposed to paying $300 a month. So that's one way to get a real-time data feed. Then you just enter your trades through your existing platform, TradeStation or whatever platform you're using. That's a way to work around it. I mean, I do have a lot of traders that trade overseas markets that Ninja Trader obviously doesn't access. So they'll use the free version of Ninja Trader, get my software, put it on there, get a data feed for their market, and trade it through their other trading platform. Now, I alluded to this earlier. I have a special bonus for InvestorExpos because they keep having me back. I keep enjoying doing this. I keep enjoying sharing these different ways of analysis with you. It's the Order Flow Playbook, and this is actually one of my favorite courses that I created. And I talk about 10 trade setups in there and a lot of things about order flow that I haven't covered in my trading course or the Inner Circle video series. You're gonna get it for free. I normally sell it for $297. It's a special bonus when you get the Order Flows Trader 6 software. So get started now. Go to orderflows.com/oft. That says 5. Actually, it's oft 6. You're going to get the Order Flows Trader 6, the Order Flow trading course, the Inner Circle video series, the live weekly group training access, and you get the Order Flows playbook. So again, it's just a one-time payment of $7.49. Go to orderflows.com/oft6.html. And at the beginning, I talked about the book that I started writing when I left JP Morgan, 2013. I started writing this around 2014. I did take some time off from the market. I just wanted to relax and enjoy life. But, I started writing this book, and this is sort of how the software company sort of developed, is by writing this book. I started writing down my thoughts and how I look at order flow. And I'm like, why can't this just be put in software so it makes life easier for traders to see? And that's how I developed software, because I started saying, this is what I like to look for in the order flow. Why can't it just be highlighted on the chart rather than me trying to calculate this or me trying to analyze every tick that goes through? I want software that's going to do it for me. That's why I developed the Order Flows Trader software. But if you want my book and read it, it's 150 pages. It's not one of these flimsy 12-page ebooks. Now, you're not going to get the hardbound copy. You're going to get a digital download. You got to enter your name and email address and hit submit. But to get it, go to orderflows.com/book.html, and you're going to get on this page. Again, enter your name and your email address and hit submit, and it'll take you to the next page where you can download the book, Trading Order Flow. So again, in the end, we only get the chances we don't take, all right? Remember, during when COVID first hit, everyone started wanting to become a day trader or do other things, right? Oh, I want to do this. I got all this time on my hands. Look back on that time and all these things that you wanted to do, did you do them or not? Right? And the same thing comes to trading. People say, oh, I want to start trading. I want to start trading. Okay, well, you got to get started, right? Don't regret. Get started. And the best way to get started is by going to orderflows.com/off6.html to get the software, because you're getting a lot of good things, not just trading software, but you're getting all the education that you need to become a better trader, right? You always want to be improving yourself, um, as a trader. Well, all right, guys, that's going to wrap it up. I'll just take a quick look here if there's any quick questions I could answer. Someone asked, who supplies the data feed? Jeff asks. Well, you can get it from the broker, your NinjaTrader brokerage, or whoever AMP has data feeds. Ask your broker, or there's third-party data feeds, IQ feed, there's Kinetic, that connect into NinjaTrader. Right now, I don't have a live trading room. I'm just too busy to have that in the mornings. We're coming up on year end. In the new year, hopefully, I've got some big projects coming up, and there are going to be some live trading sessions coming up in December. Is this similar to volume profile? No, it's volume profile is different from order flow. Volume profile, basically, you're taking the volume for the entire day. Order flow splits it up into more smaller chunks to look at, right? You're looking at a minute-based chart, you're looking at a tick-based chart, you're looking at a volume-based chart, as opposed to looking at the whole volume for the entire day. Okay, so there's that difference. Order flow is best used intraday. It's not something you're going to buy and hold. You make a trading decision right now and hold it for a week. That's the difference between things like market profile and order flow. All right, guys. Well, again, thanks for taking the time out of your schedule. I really appreciate it. Again, I hope you guys got some good nuggets of information that you can take and start applying to your trading. And at the end of the day, you want to just become a better trader. You want to be able to use all the information that's available to you and maximize it, right? There's no point in not using the information that's out there, right? It's there, use it, right? That's what's going to help you become a much better trader. So anyway, guys, thanks for attending, and have a great rest of your day, and have a great holiday coming up. I think we got Thanksgiving coming up next week already. I mean, this year's going by very fast. So thanks, everyone, and bye-bye.